Hello, this is Mark Anderson at ExecuNet. Thank you for tuning in today. ExecuNet remains committed as always to connecting you with all the experts and leaders who can guide you through the challenges that you might be facing. And I'm very pleased to have Dan Skelly join us today. Dan is the Managing Director of Equity and Market Strategy for Morgan Stanley's Wealth Management Group. And Dan's been a long-term friend of the network and has shared his perspectives in the past numerous times on the economy and the financial markets. And he's always concise and direct and a person you can trust. In any event, given these times, I really wanted to have him back to share his views and his wisdom on what we all should be thinking about and considering. So Dan, welcome. Thanks for being here.
Thanks very much, Mark. It's great to be back with you and on the program.
Great. Dan, we all understand that no one's got a perfect crystal ball in these uncertain times regarding the healthcare crisis we're in, the economy that obviously is disrupted, and the financial markets. What's your overall view and what should executives understand?
Sure, Mark. So in terms of our overall view at Morgan Stanley, what we've been saying to folks the last couple of weeks is we think that the market's going through obviously a tumultuous period, reacting to this dual shock of coronavirus economic impact and health impact, as well as a pretty dire oil price correction that was a function of the Saudi-Russia pricing war that erupted a few weeks ago. And so markets are trying to digest all of this incoming news, which in many ways is frankly unprecedented in its scope and magnitude and character. And so what we've been saying is that we think that the market drop from February 19th to the recent lows on March 23rd appropriately and largely started to discount for what will be a very sharp, but could be very short recession. And that's a big question mark, Mark. It's a question of how long does the economy stay closed for? How and when does the economy open, and what nature does that opening take? And so these are some of the question marks that are certainly out there. And I know we're going to talk about our market views more in depth later on, but our broad view is that, when you look back at history, you tend to have 20% and 50% corrections. And really what you got from mid-February to late March was in between. It was a 34% drawdown, peak to trough, which historically, that's a lot of damage. And it was really, the fastest bear market in history. I think some of that is a function of some of the players in the market, and I'll talk more about that when we get to the market itself. But we are encouraged to see some signs of stabilization globally on the virus. We are encouraged to see some signs that volatility has started to subside a bit following the, significant policy announcements of the last several weeks. But nonetheless, we still think there are question marks as to duration of the recession, the nature of the reopening, and then really what is the medicine and the science updates and dynamics look like come this fall, where there's clearly some concerns and ambiguity around a second wave.
So when you look at what's likely to happen in your view, and I know there are question marks, but what is your view of how long it will take the health crisis to not be over, but to be under control enough so the economy can start to get back into place? And kind of what do you see as the key things to be tracking that would help somebody understand how far along in this process we are?
Absolutely, Mark. So a couple of things to keep in mind, and I feel like a lot of us in the investment community and the strategy community have endeavored to become armchair epidemiologists in the last month or so. I know I certainly have learned more about this topic than I ever thought I would entering financial research. But that being said, there are data and there are trends to observe now that that do give you some context for what's going on. And we've also drawn upon, I'd like to note, Morgan Stanley's vast healthcare research team and our biotechnology's kind of updated data tracking resources that we could certainly provide you and your listeners. And so a couple things to note. On the one hand, while the virus itself is admittedly ambiguous, we now have 4 or 5 months of data to analyze. And what some of that data suggests to me is that there are strong indications and evidence that containment and mitigation and social distancing has a pretty powerful effect. It works, of course, on a lag. And so if you think about the epicenter of the crisis starting in China and flowing to Western Europe and other parts of the Middle East and now the United States the last month or so, what you've seen is a pretty clear trend in the data, which is to say in China and Korea, the containment measures had a noticeable impact. We are just in the last week or two starting to see the rate of change on both infections, hospitalizations, and mortality start to seemingly plateau in Italy and other hard-hit areas of Europe. And just this last couple of days, frankly, where I live in New York City, we're starting to see some potential signs, some glimmers that the New York City crisis is starting to plateau as well. Now, what does that mean? It likely indicates because New York is such a highly dense, most dense place in the country and one of the most dense places in the world, and it's so internationally trafficked in terms of international travelers, that New York is truly the tip of the spear for the United States. And so if you assume that New York could be potentially peaking this week or next week, our math follows that the rest of the U.S. is likely to peak in the next, call it 4 to 5 weeks. So, that's important on a number of levels. First and foremost, it's important, obviously, on the humanitarian level and the health level. It's also important in terms of markets and investors trying to look through towards what could be the restart of the economy. Morgan Stanley just put out a very comprehensive piece, which is another report I'm happy to share. But we talked about the prescription to restart the economy. And what we talked about was the idea that you're going to have a gradual restart of the economy. Things aren't going to obviously go back to 100% open and back to normal. There's still likely going to be elements of social distancing in place. And so this collaborative analysis between our healthcare team, our economics team, and our strategy teams, in essence, and all in, thinks that we're going to have a very sharp dip in GDP growth in the second quarter, a very sharp snapback in the third quarter, and a bit of a leveling off positive, though, in the fourth quarter. And so, again, that accounts for or discounts the fact that we're going to have this gradual restart. I'll close this comment by saying a lot, of course, hinges on the development of medicine and science. As I alluded to earlier, there are a couple of key factors to track on this front. One is what are the updates in terms of antivirals? We've obviously seen reports in the news and other areas that there are evidence building that there's some positive impact from some anti-malarial drugs, hydroxychloroquine, in combination with others. Now, these, of course, haven't gone through the most robust clinical studies yet. They're being used on an emergency basis, as the FDA has now approved them for. The second thing, on a more formal basis, is a company called Gilead has a drug called remdesivir that's coming out in the next couple of weeks or so. That has gone through a clinical trial. It's an antiviral. So, we don't know, obviously, what that trial readout will be. But that'll play a key role. If we have substantial therapies and antivirals, that could play a key role in bringing back the economy sooner. Convalescent plasma is another therapy where you take the blood and plasma of recovered patients and infuse it into current patients. There are people trying to figure out how to synthetically derive and manufacture those antibodies. And then the third part of this overall science and medical issue is related to antibody testing, which is going to go a long way in terms of showing folks who is exposed, who wasn't, who's immune, who isn't, who can go back to work, who can't. And more clarity and more visibility around that particular tool, which I think is coming this month, is going to be very, very helpful to figuring out how do we go back to work in stages. The very last comment I'll make is the ultimate, and largest linchpin tool medically we'll get is a vaccine. And many folks at Morgan Stanley who are more expert than I don't see a vaccine coming likely until maybe fall of this year at best, or more likely in the beginning of 2021 for the general population. This fall, there are some indications that you could potentially get a vaccine to be utilized for first-line workers, doctors, nurses, et cetera, in case there is a second wave.
Okay, well, so following that path, if you were saying, and I understand your base assumption on the healthcare crisis solutions, when you look at not 2020, which you described as sharply down, sharply up, and then more even, what type of growth would you be expecting as we move into 2021? Is it getting back to anywhere near the levels that we were in before, or is that going to be a slow growth for a while?
Yes, so that's an excellent question, Mark. So our economist, Ellen Zentner, predicts 5% GDP growth in 2021. So I believe her negatively newly revised GDP all-in number for 2020 is down 2%. So, clearly you've got an easier comparison, mathematically wise, coming into 2021. And so you're clearly having a better year in 2021. I think, that is certainly subject to variability around what is the robustness of a vaccine. Clearly a vaccine earlier and more effective would play, I think, a greater role in generating economic growth.
Mm-hmm. So when you look at that, and I'm going to say, okay, what you believe is going to happen on the health front, what would upset that happening? And what's the key assumption that we should be following as business leaders that's going to say, hey, that's really doing a lot better economically in terms of getting back in shape, or it's going to be a lot longer as a result?
Yeah, so that's a really interesting question. I would say a couple of things. One is, I think it comes back to the trajectory of the virus and the solutions to the virus. So, to the extent that the virus is hopefully dampening down by the summer of this year and into the fall, is there a seasonal effect of the virus? Meaning, does the southern hemisphere, which is then colder, start to see its own outbreaks? And do you then have to limit travel restrictions in again, global U.S. cities and other northern hemisphere cities? And that could certainly, that could have an economic impact. So, to the extent it is seasonal, that's something to monitor. The second thing I would say is related to, the economic impact. We talked earlier about our view of this short, sharp contraction and the snapback. What is the kind of hit to small businesses, and what does the default cycle look like? What do bankruptcies look like? We tend to think that crises in general accelerate trends and movements already in place. So they tend to act as accelerant to things already in place. So, some of the major trends we've talked about in the past and your listeners are well aware of involve the move from brick and mortar to online, the move from office space to remote from home. We can all now say with many Fortune 500 companies and small medium business companies working from home, the experiment is working out. Where the internet hasn't broken. And so I guess the question is, on the other side of this, what do some of those existing trends look like in terms of the impact to retail, to real estate? We talked a little bit about the energy market. And so, I think this is a time truly that augurs for a focus on active thinking in the investment market. And we'll clearly get to the market, but it's been an environment the last decade or so where passive strategies dominated amid a backdrop of low volatility, high stimulus, monetary balance sheet expansion, but really an environment where a lot of money flowed through the financial assets. And I think the next year and the coming years, I think you're going to see more differentiation between winners and losers as a result of this cycle and this coronavirus-induced recession. And I think all in that augurs for having a more active focus towards your investing.
Okay, just one last question on the economic trends that you foresee. How much are we dependent on the rest of the world in this environment?
Well, that's a really interesting point because if you think about the U.S. economy, 70% of our GDP stems from the consumer. So this is truly an environment where having this record fiscal stimulus and this monetary backstop to the markets, this is really, really important in terms of backstopping what will be a pretty nasty hit for the economy near term. It's a record stimulus. To put it in context, we did $2 trillion in the phase 3 fiscal package. That's going to equate to about 9% of US GDP. To put that in context, in 2008, we had a fiscal package that equated to about 5.5% of GDP. So you're almost double the size of the fiscal impact. And again, that's really, really important because it hopefully helps backstop. It's not a panacea, but it helps backstop some of that issue. So, it's important to recognize that this stimulus is going to help boost the or kind of backstop the consumer. You mentioned how dependent are we on the global economy? Well, there's no one who's a bigger driver than the global economy than China. So, when you look at global GDP the last several years, China's growth has been slowing, but because it's such a high starting point, China's been adding probably 30 or 40% incrementally to global GDP growth. So, China's size and steadier but lower growth is still the big mover that moves the dial globally. So a big question mark is what happens to China in all of this? We were in a, before coronavirus world, in a BC world in January and February, we were on the path to better growth in China, as largely as a function of the trade deal overhang having been dissipated somewhat. And so you saw data, manufacturing data, export data, trade data, both in China and Europe, which is Germany, which is very correlated to Chinese growth because of the trade relations, improving dramatically. And so a big question mark is, what does China do? Now, on that front, briefly, we have seen economic activity in China start to come back somewhat. I say somewhat because, you have a lot of Chinese government data, and then you have some multinational corporation data. And so you have a way of kind of corroborating the data to see what is fairly reasonable, visibility. And what we've heard from major U.S. companies is, retailers, 80, 90% of their stores are back open. The question is, what is the traffic going to look like? And, I would say while manufacturing plants are open, retail stores are back to open after their initial, pandemic epicenter, it's certainly not 100% back to growth. Now, the last thing I'll say is China, unlike the U.S. and unlike Europe, and even Japan recently, China hasn't played all of its stimulus cards just yet. In fact, relative to 08, while we went bigger than 08 in the U.S., China actually was the biggest source of stimulus in 08, 09 as a percent of their GDP. Today, China has been a little bit more deliberate in their path. They've certainly made the banking sector, more amenable in terms of cutting reserve ratios and stimulating some of the economy, but they haven't yet pulled out the big stimulus bazooka yet. And I think, frankly, that's probably not the wrong idea either, because they're probably waiting and seeing what does the path of the recovery look like both domestically and in the U.S. But keep in mind, they do have that card to play as well to get more stimulative.
Okay. All right. Well, let's turn to the markets because with that understanding of your perspectives on the economy, what are you expecting there, and how should, again, executives be understanding or what should they be doing or thinking about?
Sure. So, this has been a truly dramatic and historic environment for the markets in terms of, as we talked about earlier, the speed of the correction, the speed of the rebound, as well as, the volatility. And what we've been telling our investors, our clients over the last couple of weeks, Mark, is we think the market is starting to go through several conditions and criteria that set up for a more sustained bottom. Because the markets, as we all know, will look forward and think through to what does the path of the virus look like? What does the path of the economy rebound look like? Way ahead of getting the official numbers. The market tends to discount those things ahead of time. And what we've been working with is what I've been calling the 4 Ps framework. And this is how I think about the conditions and the objective template to think about how the markets can make a bottom. The first P is what we've been calling peak panic. And what we saw was the volatility as measured by the VIX index, which measures how dramatically the equity market moves. The VIX index a few weeks ago, Mark, closed several days above 80, which is higher than it went in 2008. And it has, I'm encouraged to say, it has been since then, since the middle of March, been making lower lows, and the VIX has now come down to the mid-40s. It's almost been cut in half. That's a very encouraging sign from our vantage, because when you look at markets historically, typically when you have a dramatic shock or dramatic correction, volatility has to peak before the market can make its low. That was the case in 2015 with the first energy crash. It was the case in 2011 with the European double dip recession. And it was also the case back in 2008 in the global financial crisis. Volatility peaked about a month to 3 months on average before the market made a sustained low. Now, history never repeats exactly, as Mark Twain liked to say, but it often rhymes. And we think seeing volatility reaching that very, very high level and now having come down is the first key condition for achieving a market bottom. The second P and the second condition is policy. We talked a little bit about this before, but I don't find it coincidental that the market low, S&P low on March 23rd, came on a day where there were two very important policy dynamics. Number one, when you came into the market on Monday morning, there was a lot of fear, and the market opened down about 8% because the Congress delayed their vote on the fiscal package. To me, that was a very important update, a very important landmark, because to me, it illustrated peak capitulation around Congress helplessness. And what's more important, later that day, another policy dynamic came up, which was the Federal Reserve coming out and saying, not only are we going to do a big amount of QE, we're going to do unlimited QE to help support the markets. We're going to buy corporate bonds to help solve for some of the liquidity disconnects in the fixed income market. So March 23rd, which is now, it's currently standing, we'll see if that lasts, as the low in equities, came on a day where people were incredibly fearful and helpless about Congress, and then seeing the Fed say, we'll do unlimited QE. I don't find that coincidental. Now, as we talked about before, a week later, what did we do? We passed the biggest fiscal stimulus package in history, 9.5% of GDP. So policy, my second P, is another important landmark, another important dynamic catalyst to think about the market hopefully making a bottom. The third P is positioning, and I talked about the speed of the correction before, and one of the reasons why the correction happens so quickly is that it has to do with the players in the market, and the players in the market have changed dramatically over time. In the last 15 to 20 years, the incremental buyer and seller of stock in the market tend to be fast-moving, leveraged hedge funds and institutional traders, risk parity funds, quantitative investors. On our estimates, these investors, following a very strong 2019, they were very exposed to the market. They had bought a lot of stock, they had levered up, and what we've observed over the last 5 weeks, Mark, is a lot of these folks have sold aggressively. Why is that important? It's important because you can have your fundamental analysis, your outlooks, your objectives, but you also have to square how that actually works in the real world, or how that corroborates in the real world. And again, a 34% drawdown was, in our mind, exacerbated in scope and speed by this dramatic deleveraging by very aggressive institutional hedge funds and risk parity funds, which, oh, by the way, inherently structurally sell as volatility rises. We estimate that those players today are about as least exposed they've been to the market in the last decade. That's important because that liquidation event is in the past. What it tells us that you may have a bumpy bottoming process in the coming weeks and months, as you always do when bear markets try to bottom. But we think that dramatic 20, 30% drawdown won't be repeated because, frankly, the aggressive players have already sold. The fourth key, and I'll just close here, has to do with the pandemic, which we've largely covered already today. But if your base view is that the headlines around the pandemic, in terms of the rate of change of the curve, not the obvious dire, health headlines. If your view is that the rate of change on the curve is slowing and improving in April and in May, then we think that's the last condition that the market needs to see to try to sustainably grind higher. Now, back in 2003, when we had the SARS epidemic, the market actually bottomed the week after SARS cases peaked. And so we are paying very close attention right now to the U.S. Trajectory. We are encouraged to see the rate of change improving in Western Europe. We've obviously seen that play out in Asia and Korea and China, where frankly, they're already restarting parts of the Chinese economy like we talked about earlier.
So if you were essentially moving to the investor side of this equation, your recommendations would be what to them short-term and long-term?
Sure. So, short-term, I think you need to be very cognizant of the fact that while volatility had an extreme level in mid-March, it's still at elevated levels. And so what we would advocate on a short-term basis is whatever changes or movements you make, do it on a gradual and dollar cost averaging method, meaning if you have $100 to put to work, don't put 100 all in one day. You want to move gradually and move in paces. On a longer term basis, Mark, what I would advocate, and what you've seen from our Global Investment Committee and Mike Wilson and Lisa Shallett, who head that up, we have actually made several changes to our long-term asset allocation in the past several weeks, and these are also resources that we can share with folks who are interested. But on that front, in mid-March, we added to large cap growth stocks. We added to small and mid cap U.S. stocks. We added to investment grade credit, and we sold some of our long duration safety treasury exposure, which had obviously done very well in terms of the panic environment. And then in just the last week, Mark, we've made another change. We've added to high yield bonds, and we've added to commodities. And a couple comments on that front. So on a long-term basis, the punchline of that entire description is to say, we think while we don't know the bottom is in today or tomorrow, and we certainly could remain bumpy here, we think enough damage was done in terms of valuations to both equities, investment grade credit, and even high yield credit that you could start adding some exposure to these areas. And we have been over the last several weeks, particularly if you have a 1 to 2 year view. And just a note where I just left off, on the high yield side, it is, it's very interesting to see that high yield spreads widened to about 1,000 basis points in the last couple of weeks, an event which has only happened 4 times in the last 40 years. And so that really is an extreme level of valuation anomaly in high yield. What we've observed is over time, once you have a peak in spreads or a peak in widening, typically you have really strong double-digit returns over time, and that's just from analyzing the data. And so again, we think on a longer-term time horizon, Mark, 1 to 2 years, you've been getting paid to be adding in, call it the 2,400 to 2,600 level on the S&P to equities, and we think at now 900 basis points, because the spread has come in a little bit, that's a pretty attractive level to be adding to high-yield bonds.
So in that sense, the risk reward, in your view, long-term, is towards holding equities and growing with the opportunities there. What's your view towards bonds or interest bearing, and what's your view on inflation?
So the 2 areas we added to in the bond market was initially in mid-March to investment grade credit, which is some of the parts of the bond market that are up in quality in terms of their balance sheet strength, their business model, their coverage ratios, their financial metrics. And that was attractive because that spread widened to about 350 basis points, which is a 10-year wide in terms of that valuation. The other area of fixed income we added to, admittedly, is more risky, which is the high yield market. These are areas of the bond market that have less credit quality. They have certainly less coverage on the balance sheet in the cash flows. But we think a lot of that uncertainty and the economic default cycle risk was priced in at around 1,000 basis points. That's a very, very atypical, cheap level of starting point. And look, there are going to be areas of pain in the high yield market. We talked earlier about what are some of the structural, near-term and structural impacts of the current crisis on energy, on retail. Those are 2 areas that make up a pretty big chunk of the high yield index. And so that's why, in line with my comments earlier, we've been advocating to being more active in the high yield market as well. So if by picking active managers who can sort through the distress, we think you'll be best suited in terms of your returns.
Makes sense. Let me just kind of end or come to a point. When you look out 2 years, and you normally have targets, S&P targets or otherwise, when you look out, what are you projecting if things kind of follow the view that you're espousing?
So Mike Wilson, who sets our S&P targets, he had fairly actually below consensus numbers for this year based on a lot of other reasons that we haven't talked about in terms of where we were in the cycle and the level of margins and the level of disconnect between people's pretty optimistic views for this year after what had been a really strong 2019. But clearly, no one saw the coronavirus coming, including us.
Right.
But Mike's estimate right now, his base estimate is 2,700. So we've actually, because of this big rally off the March 23 lows, Mark, we've actually slightly breached his base case. Now his bull case, his upside case, assumes 3,000 for end of this year. So what would increase the probability of the 3,000? I think it stems from a lot of the topics we talked about. What is the pace of improvement in terms of the virus, the medical solutions, the restart of the economy? In an upside case where things come back more, we can certainly get to that 3,000 level. But I think a lot of things really hinge again on the medical and the scientific update. And then the last thing I'll say is clearly earnings are going to get really whacked this year. They could be down 20, 30% in the S&P. We've certainly taken our earnings numbers down. But what Mike has pointed to is that for 2021, we think there's a decent earnings recovery. We talked earlier about how Alan Zentner predicts a 5% or so GDP growth rate. We think S&P earnings can get to the high 150s next year. So, that could presume a pretty decent return in 2021.
So when you look at that, what is kind of the projection for 2021, if that were?
Well, so on that note, I'm loath to front run Mike, and luckily he doesn't get asked to make that official projection until November. So we can certainly come back and chat again then, but he doesn't make the next year till November.
Okay, all right, fair enough. Now, is there anything else that executives should be thinking about in terms of their companies or their investment approach?
I would like to close by saying what I should have said up front, which is I really do wish the best for everyone in this environment, first and foremost with your families and your health. Secondly, as it pertains to your commercial endeavors, hopefully some of our advice and our thoughts around the big picture trends have given you some insight into that. I do wish for your financial and commercial success as well. Hopefully some of these small business loans and grants can be of usage. And I wouldn't rule out, again, seeing more stimulus down the road. I think the policymakers are very on top of this in a good way. And I think there could be, another round of this as well. So we'll see what happens there. But no, just want to close by saying those things. And I think in terms of the investment landscape, clearly these are the environments where having a plan, having a clear financial advisor give you advice and helping you think through not just the market and financial updates, but also the emotional updates, because I think we could all attest to the fact this has been a very draining environment on us mentally and emotionally the last couple of months. And that's when it really, I think, augurs for having that professional advice. So that would be some of my closing thoughts, Mark.
Great. Well, I really want to thank you for sharing your perspectives, because I learned something, and I'm sure anyone listening would have learned something. And I really appreciate you coming on and sharing it with us.
My pleasure. Thank you for having me.
All right, great.